Hello, welcome to the financial statement series at the Peterson Institute for International Economics. I'm Nicolas Véron, and it's my pleasure today to introduce the session on what reforms the US financial sector needs. I want first to thank, as ever, the team at the Peterson Institute for the support for this series. I won't mention them all this time, but this is very much a collective effort. Our session today is really one in which we want to think in broad terms about financial reform in the US. There was, of course, a big wave of reform associated and in the immediate aftermath of the financial crisis of 2007 to 2009. And many changes were brought to the system at that time. How radical they were or incremental is one thing that we may look back to during this session. And then we had a period of implementation and, of course, a change of administration, which also led to different directions in some aspects of financial sector policy. Even so, the Trump administration has not enacted any legislation as consequential as the Dodd-Frank Act of 2009. To discuss this today, I have I'm very grateful to my two guest speakers. And first we will start with Atif Mian, who is the director of the Julius Rabinovitz Center for Public Policy and Finance at the Princeton School of Public and International Affairs. And he's also there, I think I will say it all, the John H. Laporte Jr., class of 1967, professor of economics, public policy, and finance. Atif Mian studied at MIT, initially mathematics and computer science. He got his PhD there in economics in 2001. He taught at University of Chicago, at University of California, Berkeley, and has been at Princeton since 2012. He's the co-author of a book that had considerable resonance, House of Debt, co-authored with Amir Soufi in 2014. He also has policy experience as he served, albeit briefly, in the Pakistani Economic Advisory Council 2 years ago. The second speaker will be Patrick Honghan, who is, of course, a fellow at the Peterson Institute and a very respected member of the central banking and economic policy community. He studied at University College Dublin at the London School of Economics, where he got his PhD in 1978. He worked early on in policy environments at the International Monetary Fund, at the Central Bank of Ireland. He was economic advisor to the Taoiseach, the Prime Minister of Ireland, Garret Fitzgerald, in the 1980s. And then he had a very distinguished career at the World Bank and also at the Economic and Social Research Institute of Ireland for a couple of years. Has been a professor at LSE, University of California, San Diego, Australian National University, University College Dublin, Trinity College Dublin, which really covers the space, and of course was appointed in September 2009 as the governor of the Central Bank of Ireland in an environment of financial distress already, which would soon become a full financial crisis. He had very much a reputation there as a straight talker, and I hope and expect that this will be the case today as well. He stayed as governor until November 2015, and since then has been honorary professor at Trinity College in Dublin, but also, of course, with us at the Peterson Institute for International Economics. So enough for introduction, and I'm giving back the floor to our two speakers. Over to you, Atif.
Thank you very much, Nicolas, and thank you to the Peterson Institute for having me, and thanks, Patrick, for joining us as well. I see my job partly to talk about what is needed in the context of financial reforms, and so while there has been some great work and a lot of things we have learned over time, I will try to focus on what needs to be done that has perhaps been not looked into as much as it needs to be. So just as a premise, if I sound a bit critical, perhaps that's not the only intention, but it's driven by this desire to focus on what might be lacking. So I'm going to basically be making two main points, and let me summarize them. The first point regards to the need for financial reform to deal with the cyclical problems that an economy might face. So think of business cycle fluctuations like the 2008 crisis, and boom and bust cycle. How should we think of financial reforms that deal with that sort of a problem, right? That's sort of the first framing I would give to the question at hand. And the first point I would like to make in that regard is that while we have done a lot to deal with the cyclical fluctuations, our focus, in a sense, has been too narrow. And the reason for that is that the primary focus of dealing with cyclical fluctuations with regards to the financial system has been to protect the financial system itself. So for example, making sure that the banks have enough capital, making sure that the banks have enough liquidity through the central bank. And all of that is extremely important. And of course, that needs to be done in different ways that people or policymakers have tried to ensure. But what is missing in this framework, in my view, is that there is not enough of an appreciation of the broader framework within which the financial sector sits. And the key point there, in my view, is to focus on risk sharing. That is to say, the financial sector, one of the important tasks it performs in the economy as a financial system is that it shares risks across households and firms in the economy. And there can be times when, through regulation of different sorts, you're able to protect the financial system. So let's say banks are able to survive and so on. But the way you do that is such that most of the risk of the macro shocks that the economy is experiencing through the cycle are borne by households, let's say the indebted households, who are in many ways the least capable of absorbing those shocks. And so when that happens, a natural consequence of that for the overall economy is that it tends to suffer a lot more than it otherwise would have, right? So this, again, this concept of risk sharing is critical, and one of the important tasks that the financial sector does, sometimes directly and sometimes indirectly, is how much of this risk sharing actually happens in the economy. So again, my first point is that we need to think more carefully about what the financial sector is doing in terms of risk sharing. I'll come back to that in a minute. The other point I want to make with regards to the financial system is to think not just about the cyclical component of the economy, but also the long run or the secular trends in the economy. And there I would focus on one key idea that has been overlooked, in my opinion, when thinking about the financial sector. And that is the long run consequences of persistent imbalances that have been building up in the global economy and within advanced countries such as the United States. And in particular, I want to touch upon the imbalances that have crept in as a result of this rising inequality that everyone knows about. We all know it's kind of a point of concern for many reasons, but I think what is underappreciated is that this rising inequality, and when I say inequality, I really mean the rise in the income share of the top 1%. What is really of concern is that this structural change, and it's really a structural change that starts from 1980 onwards, this structural change, again, from the perspective of rise in the share of income of the top 1%, that has important implications for the financial sector. In particular, one of the important consequences of this rise in inequality, as I have tried to point out in recent work with Amir Sufi and Ludwig Straub, is that a rise in inequality, because people at the top 1%, they tend to save a higher fraction of their lifetime income, a greater share of income going to that group also leads to a savings glut of sorts, which is driven by this higher savings, total dollar savings coming from the top 1% of the population. And that savings glut, quite naturally, has to be channeled through the financial sector. And so that process, that buildup of those imbalances has resulted in sort of a bloated financial sector, if you like. And you can see this very clearly through this rise in total credit to GDP since 1980. It has more than doubled by and large globally. And the core problem is that most of that increase actually has not gone into financing productive investments, but instead has gone into financing consumption and demand. And so that's a longer run problem that is really now starting to drag the economy. And the reason for that is that such a large buildup of debt, or call it financialization, can only be sustained if interest rates keep going down, but you have a problem when interest rates get close to zero, as they already are. I mean, I'm talking about even long-term interest rates here. And so then you get into a real trouble. You get into sort of conceptually problems of stagnation, problems of debt traps that have to do with, very low interest rates beyond which, the economy cannot progress efficiently. So again, coming back, I think those are the two broader problems that financial reforms need to incorporate. This is something that, again, I would say has not been emphasized enough. And let me just try to, in the last couple of minutes, let me just try to give a few examples of what I mean by what hasn't been done or what should have been done. So let me go back to the first point I made, which again was that from a cyclical perspective, we need to focus on risk sharing. Now, just to give you one example, risk sharing would mean in the context of households that in the event of a downturn, the indebted households get some reprieve. Now, we have had a lot of evidence that has shown since 2008, shown the importance of giving reprieve to the indebted households. And in particular, reprieve from the perspective of, lessening their cash flow obligations. If I owe $1,000, if things turn really nasty, I'm not demanded $1,000, but maybe $900. I'm given a reprieve of $100. That would be an example of risk sharing. Unfortunately, the way financial reforms are written right now, financial regulation, is written right now. So take capital regulation. It prioritizes for the banks that they lend in through financial contracts that actually pass on the entire risk to the indebted households, because the risk weights for capital would be the lowest if banks hold what is considered the safest debt, which by definition means that in the event of a downturn, the entire loss is absorbed by the indebted households, not by the bank, and hence the investors who are holding that debt directly or indirectly. That's very inefficient from a macro perspective, as I just tried to highlight. So we need to take those real linkages and the lack of risk sharing, the consequences of lack of risk sharing for the broader macroeconomy into account when we are designing financial regulation. So from that perspective, again, going back to Basel capital rules as one example, it actually makes little sense from a true macro perspective that you would actually incentivize banks to pass on all the risk to indebted households. So instead, we need to be more intelligent when designing such rules and policies. And we need to actually incentivize the financial sector to design more interesting, smarter financial contracts that actually move towards, again, this core idea of risk sharing that I wanted to highlight. The last thing I'll say on this score, and Nicolas mentioned the Dodd-Frank Act as well, there's an important component of that act, which was the living will. And it was very good intentioned, and I think going in the right direction, the idea being that push comes to shove, banks must say, this is how we're going to resolve problems in our balance sheet. The problem with this view, however, is that it's not credible. We have seen time and time again, and COVID-19 is another example of that, that when push comes to shove, no authority, central authority, will have the courage to actually demand banks to execute the living will. So we need to think of regulations in a credible way. And I believe what that means is that there need to be automatic risk-sharing mechanisms embedded inside the financial contracts so that we are not relying on someone's discretion or some centralized authority to come in and sort of call the shots when things are really bad, because that view of regulation is not incentive compatible in a dynamic sense. So I'll close on that and look forward to the conversation and discussion with Patrick and others. Thanks again.
Thanks very much, Atif. Many questions there. Patrick.
Yes, many questions, but not for me any contradictions. Let me say right away, I agree with Atif that the way finance has been working in the United States, but also in many other countries, not perhaps to the same extent, that it's producing a skewed distribution of risk in the economy and some longer term debt traps, low productivity. And I think it's not just an assertion. I think many people listening to the conversation will be aware, but some might not be, that Atif's propositions are backed by a huge amount of research, data-based research, very sophisticated research, which establishes the points that he makes. And he makes, I think, the general point that it's these kinds of big macroeconomic dynamics, and not just the question of bank solvency or liquidity, that should be central stage in public policy analysis of the US financial system. Let me make just 3 points. First of all, of course, it's not just a question of policy tools. You've got to develop a policy environment. And in order to widen the horizon of financial policy making in the US, the various financial sector policy institutions and agencies will have to be actively thinking about these kinds of wider societal impacts about the way finance is working. And are they? I wonder, do we see a glimmer of this in Chairman Powell's announcements around the strategic review of monetary policy, which he announced last month? I mean, not only is the Fed now looking at something more like an average inflation target, allowing an overshoot of the 2% to compensate for the undershoot that has occurred, but also now, perhaps for the first time, an explicit acknowledgement of distributional considerations in monetary policy. I won't read out the quote that he made, but we do have this explicit acknowledgement. Maybe it's also a preemptive move in light of Senator Biden's proposal to widen the mandate of the Fed, but this may suggest a chink, an opening in the most important policy institution in the United States, the Federal Reserve, to really start thinking about these wider distributional issues. There was, after the global financial crisis, there was a financial system oversight council was set up, chaired by the Secretary of the Treasury, assembles the heads of most of them, regulatory bodies, 25 people around the table. And that would seem to be an appropriate forum for developing policy initiatives and thinking. But by most accounts, it has been pretty passive, even in the narrow fields of traditional prudential policy. And I have the feeling that little progress will be made if this FSOC doesn't become more active and innovative. And I think that's where it's an ideal place for Atif's ideas to be fleshed out, amplified, and turned into policy initiatives. Second point, so better risk sharing, how do you achieve it? There are many kinds of institutions, contracts, financial engineering, as you've mentioned, shared responsibility mortgages. The one type of policy which could be specifically relevant to the mortgage market dynamics that's important in what Atif has to say, and that's borrower-focused restrictions, such as ceilings on loan-to-value in mortgages and loan-to-income ratios. And the curious thing is that in the United States, although okay, the GSEs, the specialized mortgage agencies, they do have some rules on the eligible mortgages for their operations, and they say something about such ratios. But in general, it's fair to say that these tools have not really been used in the United States, but they have been used in other countries. But I think they do raise the question. I mean, these may help to insulate the lender, but they arguably also protect the borrower from over-indebtedness. At the same time, they make it harder for lower income households to get to owner occupation, and they're politically unpopular. It's a big call for a regulator to bring in tight controls of this type. And it also raises questions of democratic legitimacy if Parliament, Congress doesn't have a role. And that's probably true of more interventionist policies, any type of more interventionist policies in this area. Actively pushing the market in a different direction to what we've seen does require a political buy-in to what would be seen in some quarters as active social engineering. So I just take that example of those kinds of tools being very politically unpopular, not used in the United States. Why? probably because they're politically unpopular. So Atif's proposals may lead to a better financial system and a better macro financial structure, but how do we get there? How do we get the political buy-in? Third point before I finish. It's likely that some of these issues will once again be put on the back burner while financial sector policy turns with dealing with the economic downturn caused by the COVID pandemic. Well, I want to point you to a nice publication from the IMF a few weeks ago, Financial Sector Stability Assessment for the United States. They only do it every 5 or 6 years. So this is quite a good place to go to see what does the financial sector look like and what are the threats, including the threats from COVID. Let me give you a very, very three-sentence summary. Although mortgage delinquencies are rising again, banking is not looking like the most vulnerable part of the financial system now. It's only a small part of the US financial system. And low interest rates help contain mortgage exposure. Low-income households are much less heavily indebted than they were in 2007. Student loans, of course, is a growing area. The corporate sector, as mentioned by, and if they don't get a look in, well, some parts of it get maybe too much of a look in. They've been leveraging up, huge leverage loans. The corporate sector gets most of its finance from non-banks. Remember, this is an important thing to remember about the US financial system and where it's going in the future. I think the corporate sector will be the main source of problems post-COVID, and its impact will be noticeable in the non-bank sector. And there will be a more broadly a big problem, a big issue of loss sharing post-pandemic. We may discuss this a little bit more in our discussion. Look, let me leave it like that. I only had 5 minutes, and let's move to a wider discussion.
Thanks very much, and thanks to both of you for the time discipline. Actually, I'd like to follow up on your last point, Patrick. And it is, in a way, a feature of the US financial system that makes it an outlier in global perspectives, that it has so little weight of the banks in the system as a whole. It's a very non-bank based system in comparative perspective. And indeed, we have a question from Vinay Sharma on the Q&A. There's been a rise of shadow banks after the global financial crisis, which are unregulated, so causing rise of debt while increasing risk in financial sector as Basel norms are circumvented. So I'd like to come back to you, Atif, on this. You mentioned the effects of the Basel framework, but how do you think more broadly of this balance between banks and non-banks in the US? And as you rightly called for, a holistic approach to the financial system, do you think this fact that the US is so capital markets intensive, is that something that you welcome, that you worry about, that reformers should tackle? How do you think about this?
Thanks, Nicolas. You know, I can see a number of other related questions in the Q&A that I think I can rope in all together in a sense. There are questions about, as you mentioned, the shadow banking sector. There are questions about money market funds. You know, there's the question about financial repression and all of those things. Let me give perhaps a non-traditional answer to this, but I think it's really important to answer them from this framework. It is precisely for this reason that I emphasized having the long run view and thinking more holistically about the financial sector, because all of these questions are ultimately connected. And I think until and unless we kind of make it a habit to think like that, we may be missing the big picture here. So let me, I'll take a few minutes to actually go through this logic a little bit more detail. It's something that I mentioned in my initial remarks. So I'm going to just show you some broad trends, and then I'll come back to the question of shadow banking and bank, non-bank, and so on. Let me give you a punchline in a sense, which might appear a bit controversial, but hopefully I'll try to explain it. I don't think it matters too much, this distinction between shadow and non-shadow banking. Yes, the US, as Nicolas rightly said, lower share of banks in the US. I do not think that's too important a factor. I know it's important in the short-term business cycle again, but in the bigger scheme of things, it's not too important. What is important is that the overall size of the financial sector, be it shadow or non-shadow, is very large and has been rising everywhere. Okay, that's the important piece of information for us to think about. And so let's now go back to the fundamentals of the economy. This is what I mean by the holistic approach. This is what I mean when I said the economy is an ecosystem and we must understand all of the linkages within this ecosystem. In technical jargon, this is what economists might refer to as having a general equilibrium view of the question at hand. And so let me go back to that, because I think that is critical to understand really what the core issues are. Otherwise, you can keep twiddling with things on the margin, but miss the big picture. Okay, so what's the big picture here? The big picture here, in my view, is the problem of this rising imbalance in the economy. And you can see this through the lens of the rising inequality. So here I'm showing you the rise in the share of income of the top 1%. Everyone is well aware of that. But now let me show you the second graph, where what we do is we actually calculate the additional savings coming from the top 1% in a way as a result of this rising inequality. And what you can see is that since 1980, there has been this rise in additional savings being propelled into the financial sector. And the magnitude here is really large. You know, it's like on average around 3% of GDP every year. This is a flow I'm talking about. So it's a tremendous flow into the financial sector. We must think in general equilibrium. Things have to add up. This flow has to go somewhere. If this flow does not go somewhere, we have a problem. The economy will start to contract. That's called a liquidity trap, right? So this must go somewhere. Whether it goes through the shadow system or the non-shadow system is not too important. The important thing is, where is it going and for what purpose is it going? So let me now go into that question a little bit more, and then I'll come back to kind of wrap around all of these questions that people are very legitimately asking. Where has the savings glut of the rich gone? Again, this additional 3 percentage points of GDP every year. You can do the math, we accumulate, we aggregate this up, and here's the punchline. Let me just give you the punchline, it's quick. This is the size of the top 1%, number one, the first bar. It's more than 100% of GDP, basically accumulated from 1980 onwards. Where has it gone? For it to go somewhere, we need to see a bar going the other way, in the negative direction, that it's absorbing this savings glut. And the first thing I want to show is that this savings glut, this is within the US as a result of inequality, has not been exported. As we know, the US has been importing even outside savings glut. So even that adds on to the internal savings glut generated by inequality within the US. And perhaps most discouragingly, this has not gone into investment either. In fact, investment has decreased since 1980, which is why investment is also adding to the savings glut, if you will. So what is actually happening? This is the key punchline. The entire excess in savings coming from this inequality, plus the global savings glut coming into the US, all of that has largely financed the dis-savings, that is to say consumption of the bottom 99%, and primarily it's really the bottom 90% of the US population, and increasingly so it's been financing government deficits. The bottom line is these savings gluts, global, and then this internal savings glut driven by inequality. This is the force that is putting pressure on expanding the financial sector. Sometimes it expands through the banking sector. That depends on the institutional detail. So you can pick whether you want the shadow banking system or the non-shadow banking system or the capital markets. You can have that choice, but you cannot escape the logic that if you have these saving gluts, if you have these imbalances, the size of the financial sector must continue to rise. Now, here's the final thing I'll say on that. This cannot go on forever. The only way to sustain an ever rising size of the financial sector, because financial sector at the end of the day is largely credit, is debt denominated, as everyone knows. The only way to sustain a bigger and bigger financial sector is for the interest rates to keep going down and down, and that's precisely what we have seen since 1980. And so the interest rate, while it is very low, it is a consequence. It's not exogenously given. It is a consequence of these imbalances that have been building up since 1980. So let me now come back to and take all of these questions, whether it's money market fund, whether it's shadow, non-shadow, and so on and so forth. We can talk about sort of partial equilibrium policies around the institutional details, but I feel that all of that is going to be immaterial in the long run if we don't focus on the fundamental cause of why we have this glut in the financial system. And that is driven by this fundamental imbalance that we have rising accumulation of these saving gluts that are not going into real investments. That's the core issue here. And we need to figure out why that is happening. So you either try to boost investment, that looks very hard actually, given the technology and so on, the way it's going. So then the other way to think of is that we have to reduce those saving gluts in the first place. And that goes into structural reforms, like dealing with inequality, like thinking of progressive taxation, including wealth taxes, by the way. Mm-hmm. My point is that the problem we are dealing with is much more serious than is typically dealt with in a standard financial stability framework. And we do need to focus on these structural long-term forces. Otherwise, I actually don't see a solution out of it from just thinking in terms of shadow, non-shadow terms.
Patrick, I'd like to have your view on this. Is the divide between banks and non-banks irrelevant? And also, as a European from Ireland, and you also served during 6 years on the Governing Council of the European Central Bank, how do you look at this in comparative perspective, right? Both the point about structures of the financial system, and also, frankly, the point about inequality driving all this, because as we know in Europe, we have very different inequality patterns from what they are in the US.
Yeah, I mean, well, you asked me to look at it in different, all sorts of different perspectives, but yeah, I'm asking sometimes when I read and listen to Atif, I think he is saying something about the wider economy, and to some extent, this story could be told without much emphasis on the financial sector at all. Financial sector, of course, is very attractive to people to look at because lots of details and lots of people are making money or losing money with the financial sector. But in fact, the story is not solely, but very heavily a macroeconomic growth distribution story. And that if you pulled out the US financial system and put in the German financial system in its place, if there was some kind of transplant arrangement that could be made, you would probably get much of the same results that you're talking about here. So I think that's the important insight, that we tend to look too closely at the details of the financial sector without standing outside of it and saying what is actually going on here. Which is a theme of the new book by Mervyn King and John Kay. They don't want us to make very detailed calculations about probabilities. They want us to stand away and look and ask what is going on here. And what I think Atif has put his finger on is a number of things that are going on here, which is a huge increase in inequality. And as you said, the savings and how that has been channeled. But there are some mechanisms in the financial sector which could change to some extent what were the consequences of this. For example, Atif mentions low productivity, low investment. He might be right that different available financial instruments, available in the sense that now attractive to financial intermediaries because tax structures had changed. For example, talked about shared responsibility mortgages and so forth. That might help make it more attractive for financial intermediaries to channel those savings into some other mechanism. Now, if they're only small, if banks are only a small part of this story, and if investment funds of one type or another are a big part of the story in the United States, that should make it more possible to have those kinds of mechanisms at work in the United States. You could have more equity type and risk, different types of risk sharing. And indeed, you do actually get that. So it is disappointing that despite the fact that the US has a big non-bank sector and a big use of equities, a big use of other financial instruments, that nevertheless who still end up in the traps you talk about. So, I mean, we can go off in different directions, but I'd like to hold on to this question of instruments. You mentioned you mentioned the tax system as diverting activity into fixed interest loans rather than something that might be more equity or risk sharing in the instrument itself. I wonder how easy is it to change all that? Is it just a question of changing the tax structures? I think the whole of banking is built around the simplicity of the debt contract. And so the more we get away from banks and into other types of institutions, as long as they are adequately regulated, we might get somewhere with better risk sharing instruments. Let me leave it at that for the moment.
Yeah, we'll come. I mean, obviously there were very big questions here, so we'll come back to them inevitably. But actually, just on this, we had that question from Roberto Garcia Coria on contracts. You mentioned this idea of debt contracts, which are basically contingent on the broader economy and give reprieve to indebted households in a downturn. Are there any examples of such contracts with automatic risk sharing that you have in mind, or is that something you think of only for the future? Do you have prototypes or proofs of concept that you could share with us on this, Atif?
Yeah, excellent question. But by the way, let me just say, I think Patrick very eloquently summarized and extended a lot of the things that were being discussed, and I'm completely on the same page with his thinking. On this question of financial contracts, look, I think it's important to keep conceptually what we are going after and then recognize that there are different roads that can get you there. And so again, the important principle here is risk sharing. That can be done in multiple ways. And in fact, it is already being done in varying degrees across the world. So let me give you some examples. If you compare the US with Europe, the two are not the same. There are important differences that make some places in the US much better at risk sharing than many places in Europe, for example. It is well known that it is much harder to get out of household debt in Europe relative to the US on average. And that limits risk sharing. That is a consequence of bankruptcy laws, recourse, non-recourse, and things of that nature. So when I talk about risk sharing, I want to just emphasize, it wasn't emphasized by me earlier, that institutional arrangements such as what is recourse, what is non-recourse, institutional arrangements such as bankruptcy laws and so on, they are part of what you can do for risk sharing purpose. In fact, there's a nice paper by Claire Will-Dobby and Goldsmith-Pinkham that takes exactly variation across US states in bankruptcy laws and shows that bankruptcy laws that favored greater risk sharing were actually very beneficial at the macro level for those states that had better risk sharing mechanisms put in place through bankruptcy regulation. So institutionally, I just want to highlight that there are other ways of doing this as well. Another example is, doing it through the interest rate contract. So again, we found out in 2008 that if interest rates could be automatically readjusted in the event of a downturn. So that's obviously we already have the infrastructure for that. The adjustable rate, and you can make them more sophisticated if you like, where they adjust on the downside in the event the Fed announces something or whatever. So we already have that. And now let me come to the last piece, which is perhaps the most difficult, which is, can we also do equity partnerships? Now, there are some interesting examples. There are a couple of, at least two that I know of, there may be others, venture companies in the US who are actually currently engaged in offering equity partnerships with potential borrowers in the US. So clearly, the model as a proof of concept, if you like, already exists. But let me say one last thing with regards to the more challenging contracting spaces like equity partnerships. While the examples exist, conceptually, when you go through that argument, you realize that the free market itself cannot fill that space. And the reason is it's the standard insurance argument. You have to mandate insurance when there are externalities involved. The reason we want to do this, risk sharing, there are aggregate demand externalities that will not be internalized by a private market, that will not be internalized by private homeowners, as well as investors. And so because there is a collective good involved here, for the insurance-driven features of these contracts, they have to be sort of mandated or incentivized in different ways. It is for this reason that I emphasized why it is absolutely perverse that we have it backwards. That we have actually, through tax deductibilities and things of, and capital regulation, like I mentioned, risk weighting, that we have actually done completely the opposite, which is we have incentivized the standard safe debt contract to be promoted in the financial markets through giving that kind of contract subsidies. If we could only reverse that and give subsidies to the opposite, sort of more risk-sharing contracts, I think we can have a much more robust financial system that works for the macroeconomy as a whole. This, by the way, was also kind of, if you want to read more on that, this is the last chapter of the book we wrote in 2014. So this is very much, so you have to look at the whole spectrum, you have to look at institutionally, and you have to look at mandating incentives so people can go more in this risk-sharing dimension.
Patrick, your view on this, and specifically also, I mean, how do you square that with financial stability? It's the fact that banks have to be sound enough, has to be resilient in crisis for reasons that have to do with the payment system. So how do you, I personally see a lot of trade-offs here between viewing the financial system as purely an intermediary that allocates capital and viewing it as an element of the risk sharing that has to absorb losses of its own, in which case you need to have things like higher capital requirements. So how do you think about those trade-offs?
Well, I think it's a question of how to leap to an entirely different structure. It's not easy to move from the current structure to add in a little bit of shared equity participation, shared responsibility mortgages. We've got lots of experiences of initiatives from government and from academics. I think of, for example, the idea of sovereign GDP-linked loans. This is another, changing the risk-sharing structure, which is quite similar to protecting the mortgage holders. But despite much work, the market people say, well, we're prepared to go for that, but you will not like the rate of return that we will demand on that. And I think it's probably the same, Atif, I'm sure could confirm or otherwise, that when you come to equity partnership loans, they say, yeah, sure, we could provide that. Let me do a small sum on the back of the envelope, and here is the monthly repayment you're going to have to make. And you find it's considerably higher. So a subsidy might come in, but I think it's a completely, just putting a proportion, a small block of this on top of the structure we have now will end up with unattractive price propositions. And as we know, mortgage borrowers, they always go for the contract that gives them the lowest monthly payment for the first 6 months. That's no matter what's going to happen after that, they just want to get that low monthly payment of the first. So I think it's quite difficult. After the crisis in Ireland, we tried to, where there were restructurings were necessary to avoid costly and unnecessary repossessions and so forth. We designed all sorts of schemes, mortgage to rent systems, a split mortgage where one of them was parceled and you will never have to pay it unless your house prices go really very high or that your income goes very high. All of these innovations, they went a certain distance, but they weren't the magic bullet that we expected. So I think that what Atif is talking about is an entirely different type of financial system that we can't say get there this year or next year. I don't think prudential risk is a problem for that different system, because you've changed the sharing of risk. The payment systems do not require a fixed face value deposit that's not inherent in having a well-functioning payment system. In fact, in China, people are using payment systems that hardly use any of the person's wealth at all. It's sort of separated from the banking system in large part. So I think you can have a well-run, prudently managed and functional system that is based on a different type of risk structure, but it's nowhere near the one we have now, and you can't get very far towards it by just making partial reform. Partial reforms can help, but they're not going to get there.
I'm coming back to this idea that you put forward, Atif, that in a way the structure of the financial system is second order compared to these imbalances in the economy. I have a question from Reinhold Rickes in the chat. Maybe you could, I quote, maybe you could discuss the role of local banks in the US, especially the community banks. Do you think that they could better transform savings into investment? So he seems to challenge that view that ultimately the structure of the financial system is second order. And obviously there are big debates about that in Europe as well. So I'd like to have your view on this, the role of community banks and pushing you a bit on financial system structure. Atif.
Yeah, no, thanks for that question. Look, I hope I'm not ideological on any of these claims that I'm making. At the end of the day, I'm an empiricist at heart, and I would, it may be possible that different types of financial institutions, like you mentioned, community banks and so on, that they might be better at channeling savings into productive investments as opposed to what we see largely going on right now. That's certainly possible, and I think there is something to be said about that possibility. All I can tell you is that to the extent I have looked at the data, or other people I've read other people's work, we don't have any evidence that at a large macro scale that certain types of financial institutions are more in, let's say, investment driven versus non-productive, credit driven, and so on. So it's a hard problem. I think it's a challenge that's worth investigating, but I think at the end of the day, it's a very hard problem. And that's why I was saying, look, we need to just focus on where is the savings glut coming from, and think about kind of more equitable processes of growth as being more first order to deal with financial excesses as opposed to changing just the structure of financial institutions themselves. I also want to come back to the very important question, Nicolas, you raised that Patrick was discussing earlier on. And I very much agree with the challenge of that question and the trade-off that you talked about with respect to the payment system and all of that. I appreciate that very well. And by the way, for exactly that reason, I don't want to come across as saying, okay, we need to radically go towards a completely different financial system. I want to keep emphasizing that there are incremental steps that you can take, like, including bankruptcy regulation, things of that nature. But even within the context of, again, I want to emphasize one thing. I think maybe we underappreciate it, perhaps. What we have right now is not, well, Patrick rightfully mentioned that if you take certain costs into account, the cost of borrowing will go up. Absolutely, I completely agree with that. But I want to emphasize one thing. The reason cost of borrowing looks very low right now is because the indirect costs that do hit the economy, as Ireland experienced as well, they are not internalized by the agents in the economy, by the private borrowers and the banks. And that is the problem I'm trying to highlight. It is since the discussion is on financial regulation and reforms, this is the very purpose of regulator, to internalize those costs. So I just want to emphasize that while everything Patrick said is true, we need to go back and ask ourselves, well, what is the point of having a macro-pru regulator at all? In fact, the only reason I know of is for the regulator to internalize precisely these kind of costs that otherwise would be ignored by individuals, as in the standard pollution context that we all know very well of. So we need to have that mindset when approaching these issues. The last thing I'll say on this issue, and just to give you one example of where institutional details matter. If you take the housing market in the US and you take the 30-year fixed rate standard contract that has become standardized in the US, it has not come about as the standard sort of $1 trillion market or whatever. It has not come about through free market, if you will. The reason it exists as the standard contract is because the government has standardized that contract through the GSEs and has essentially backed that contract through the GSEs. And so what I am suggesting, and again, we talk about this in the book when we talk about shared responsibility mortgages, we say, look, you already have the existing structure like the GSEs. All you have to do to go in the direction I'm proposing is take the subsidy off the current contract and give it to the shared risk responsibility mortgage contract. It's already, the structure is already there. You're already giving the subsidy. Just switch what kind of contract you give the subsidy to.
And obviously the GSEs are the government-sponsored entities, Fannie Mae and Freddie Mac, which buy all those mortgages in the US and are essentially owned by the federal government for economic purposes. Patrick, I'd like to come back to the question about small banks and more generally the question of financial system structures. I mean, I'm sorry to digress to Europe, but in Europe there's this whole debate about capital markets union, capital markets development, the European system being too much bank-based. How do you think about this and whether really we can think of the financial system as a whole, or whether the structures inside the financial system have relevance for macroeconomic outcomes?
I think that with layers and layers of regulation over the last number of years, we have made it much more difficult for small banks, for community banks to function. It's very, very costly for them to comply with all the regulations. So they reach out and try to form networks that would, with shared services and the like. And then the historical development of some of the big banks in Europe, such as Barclays and Société Générale, and not Société Générale, but Caisse Agricole, you have that merger into a large institution because the smaller institutions found that they needed to have recourse to something bigger to function. So I think that is a challenge. We know that insufficiently regulated institutions tend to go bad. So you have to have the regulation. The regulation is more complex in a more complex world, and therefore you have the drive towards consolidation. Yet we know that the large banks do not perform very effectively in providing sensitive services and a wider range of contracts. So it's a difficult balancing. I would like to see the banks, and I'm always complaining to big bankers who are trying to close down branches because they seem to be loss-making, that they're losing the local context, they're losing the local knowledge. They seem to think that this is something that they have to, they don't care because they're going to make a higher profit. Something is wrong in that balance. I don't think small banks are the solution, but they are a solution to particular types of small business access to finance. And we shouldn't be too blithe about allowing them to wither away. The number of banks in the United States, of course, was huge. It's still huge, but it's a lot smaller than it was, declining very dramatically year on year.
I have a question from Jerry Caprio on something slightly different, but which is also ultimately about risk sharing and macro outcomes, which is climate risk. He writes at his point on risk sharing is spot on, but that present US regulation is pretty much ignoring climate risk. It's hard to price. The current price of zero for climate risk is sure to be wrong, no matter what pricing model you have. So he's asking about this, forcing disclosure of climate risk, also putting a higher risk weight on climate risk. Atif, is it something you have paid attention to?
I'll come to that in a minute. I just want to going back to Patrick, what he said. It reminded me of this earlier question on small banks. And I just want to reiterate, I think Patrick is exactly right. He brought my attention to literature that has shown the importance of small banks in getting to the smaller clients, because they're closer to them. So they have and so that's very important. So I hope my earlier response is not seen as saying, oh, the smaller banks or community banks are not important. They are very important in that function. All I meant to say was that from the perspective of the macro problem that I was addressing, just having small banks is not going to solve the macro problem. So just a clarification on that. On the question of climate change, no, it's not an issue that I am an expert. The only thing I'll say is this issue of stranded assets is going to become increasingly important. And from that perspective, you can think of it exactly in the context of risk sharing and say, okay, when that happens or as that happens, I think it's clear that that's going to happen. For example, the fossil fuels assets and things of that sort, if not to mention all of the other flooding risk and so on. Who is going to absorb that risk? Again, from a macro perspective, for all of these reasons is why I was emphasizing what I call the financialization of the economy. The overall credit to GDP is incredibly high and becoming higher and higher. We have not seen any reversal in that, despite 2008, despite the COVID and everything. And my assertion is we are not going to see a reversal in that, as long as these saving gluts and so on, they keep accumulating, number one. And number two, and this is perhaps coming closer to the question at hand, we figure out ways to actually pass on the risk. I mean, at some point, debt is going to default. That's another way of saying that. We can't just keep pretending that no debt should, by and large, ever default, whether it's Italian debt or whether it's a corporate debt. Ultimately, somebody has to bear the aggregate risk. And this is why this question becomes even more important when you pose it from a climate change perspective, that there are risks out there. We hope they are not as large as some people believe. That's really the hope for humanity, right? But they are out there, and it looks like those are going to be big risks to the macroeconomy. The way the financial system is structured right now, it's not clear who's going to absorb those risks. Somebody will have to absorb those risks, that's clear. So I think that's a big question. I don't have any further insight into that.
Patrick, obviously the Green Deal is a buzzword in the US as it is in Europe. What do you think the US could do in order to tackle this issue of climate change through financial system reform? Or actually, is that an issue? I mean, is financial system reform at all a channel to tackle climate change risk, or is it going to be addressed with other types of policy action?
Well, I think it is a channel. It's in a more important channel. At least it's obvious that the prudential risks that are there and that have not been internalized by the lenders, even though it's not an externality issue, they just haven't recognized it's beyond their planning horizon. But these are big risks. I'm not terribly hopeful that they will vanish. They're big risks, and they should be factored into their risk calculations. They should, the prudential regulators, the microprudential regulators, should be insisting on this. There is movement in that direction, but we know that the regulators, when they're central banks and when they're buying assets, ECB buys corporate bonds, but it doesn't factor in a climate risk dimension to that. It certainly should. But the bigger question is, should the financial sector regulation go beyond what is necessary for prudential purposes and leverage their power to regulate in order to achieve a goal beyond financial sector stability? And here's where the financial regulator needs to have the political support from Parliament and from government, from the Congress, in order to be allowed to continue to do that. If regulators go beyond their mandates.
Do you think the answer to that question is yes, that the financial sector should, that authorities should leverage the financial sector in that
What I would say is that it's going to be very risky for the regulators to do it on their own. At least they would, if it's to be done, it would have to be by mandate of the politicians. But there's an easier way for politicians to do it, and that is through carbon taxes. This is so obvious, and they don't do it for political reasons, and therefore they will not tolerate it being done by regulators. All that the regulators will be able to get away with, and indeed it's only their mandate, is to protect prudential concerns, which are legitimate concerns and which require more effort than is being provided at present, in my view.
On this note, obviously I have tons of more questions, and there are also many more from the audience, but we have to respect our time discipline. Thanks very much for having started to scratch the surface of this debate on financial reform in the US, where I expect this debate to continue and also to be the theme for further sessions of the financial statement series at the Peterson Institute. Thanks to all participants for attending this session. Thanks particularly to Atif, Mian, and Patrick Honohan for being the speakers today. And see you very soon in the next episode of Financial Statements at the Peterson Institute for International Economics.
Thank you.
Thanks.